This video is strictly for those of you who have been struggling with supply and demand for a while now. So I made this video to specifically lay emphasis on key levels, because the main thing in trading is to get the right entry. Okay, if you enter the right place, then okay, that's the whole idea, is to predict the market, to know exactly where the market will move to, or the market is most likely to move to. So this thing is not like a guarantee or get rich quick scheme for you to maybe just come and watch one video and go and be a millionaire. No, 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 please. This video here is it's for educational purposes. It's to give you an idea. Okay, what you know already is not wrong. It's just probably for you to add to what you know, or to make some corrections or some changes. So my name is Gislen, and in this channel I share trading tips. This right here is just a random pattern that I drew. I want you to look at it. First of all, let me start off. What is supply and demand? Okay, supply and demand is just areas in the market with aggressive buying and selling. Meaning, if we have like a continuation, like if we have like a trend like this, all right, we just have the market doing what it's doing. Then we have aggressive push in one direction, either buy or sell. We are looking to take trades at that key level where the buy started or where the sell started. So we are looking to take a trade there when next price comes back in. This is because the large funds or the large institutions, the banks and the hedge funds and all these big, huge investment organizations, they stake a lot of money here and they trade a lot of volume in this market at this particular point in time, another particular time of the day. So these large and huge orders causing the price to drop drastically leaves an open space, leaves inefficiency in the market, and also leaves footsteps of these huge institutions. So now we are coming out behind as retail traders to follow their footsteps and do what? And trade with them. So we are trading with the wave, we are trading with the trend, we are trading with the big guys. You are not trading against them. You cannot trade against them. I mean, this is billions of dollars we're talking about. You feel me? So with that explanation, I hope you guys know exactly why this market moves the way they do. All right. So now here you can see an example, clear example. What are the criteria? There's a few criteria to this whole thing. So the first criteria, I want you to write it down. I'll not write anything here for you. I think I'm speaking clear enough, so you should write it down yourself. So the first criteria, okay, is to identify impulsive push. I don't care about the structure break because people they always take down the first, but I feel like the impulsive push is the first thing. Okay, you should look for volume. When you see volume in the market, good. So the first criteria here is that what? You need to identify a strong push in one direction. If you see a strong push in one direction, that's one. Now, the second criteria is what? Did it break the recent structure? Did it break maybe structure to the downside? If it broke structure to the downside, then okay. But for you beginners, maybe you might not understand what I mean by structure. What I mean by structure is the recent low or high. Like if we have the market moving sideways like this, then we have a low that is formed and we have a high that is formed. So whichever of these lows or highs gets broken out, that's a break of structure. Meaning if this price sweeps this low here, just like it did, this is a break of structure to the downside. So now we have to look out for sales, possible selling opportunities based off this high here that this strong push originated from. This is where the impulse started from. So this is where impulse was introduced in the market. This is where these big guys stepped in to say, okay, now we're tired of this whole bullshit. Now it's time for us to push this price to this certain level. Meaning maybe the price has been standing at this price here at 1.24522 for a while. And they're like, now we're tired. We have to push the price down to 1.23996. All right. So they have reasons why they do this to regulate the economy and everything. You know, there's a lot of the fundamental understanding when it comes to trading. So this is it. Price has been pushed here. We have a break of structure and we have another block here. All right. You can call it another block, you can call it a supply zone. I don't care what you call it. So now we have another block. Then now we have another confluence that I want to give you. The third confluence, the third criteria that you have to look out for is fair value gap. So a fair value gap is basically space inefficiency in the market, meaning we have like 3 candlesticks here. All right. Then we have a push like this. You know, in the market, there's wicks. There's something they call wicks. All right. Like on the candle, you always see wicks on the candle like this. So if a candle forms like this one, all right. Let me just sketch this real quick for you so you can understand what I'm trying to say. All right. Now, this is the market. This is the market doing what it's doing, right? Now, when you see this space, you see this gap here, you see this wick. Now, this is the low of this candle. All right, this is the low of this candle. So when the low of this candle does not touch the high of the third candle, which is candle C, this is candle A, candle B, and candle C. When the low of candle A does not close up with the low of candle B, of candle C, leaving this gap in between, right? It's referred to as fair value gap. It's referred to as what? Fair value gap, or you can call it imbalance. So this gap here is what I'm referring to as the third confluence. So I need to see that gap on this price leg, especially up here at the extreme zone. So when you have this fair value gap at the extreme zone, you have the impulse, you have the break of structure. These are the three most important confluences. There is more, there is way more confluences. You can maybe use the higher time frame for buyers. You can follow the trend, all of these things, trend following, buyers, directional buy, all of these things, you have to put them. And then you have these fractal confirmations. But I'm not going too detailed in the confirmations, all right? I just want to show you guys the outscale of this thing, the basics, you feel me? So the basics of supply and demand is a strong push, aggressive buys, aggressive sells. When you see these aggressive buys and aggressive sells, keep an eye on those levels. Follow these confluences that I've given you. Price will likely bounce off those areas in the future. So now I want us to go on the real charts and let me just give you guys a few examples. So right here, as you can see on my screen, there's a few areas in this price, in this market that we've had aggressive push in one direction. All right. We have aggressive push at that level. We have aggressive push at this level here. So these are very, very key points in the market that I want us to look at now. Now, how do we analyze this chart? We hop on the market here. We see structure, right? Structure is bearish. You see here, we have a low, we have a lower high, we have a lower low here, we have a lower high, then we have a lower low. All right, this is structure. So what kind of structure is this? This is a bearish structure. The market is bearish, meaning there is more sellers in this market than there is buyers. So now that we have the recent low here, let's assume that the price was still somewhere here. All right, this is our newest low, right? So the first thing that we look for is impulse. Once we see impulse, okay, we'll be like, good, I want this low here to be taken out impulsively. I want this low here to be swept out impulsively. So I'll just label that break of structure. So when you see this BOS, it stands for break of structure. So now that we have a structure break, what do we look out for? The third confluence. We've already covered the first and the second. The first one, you can see impulse. When I say impulse, I mean big candles. You can see these huge candles here. They are very larger. They are way larger than these other ones. You can see these candles here. This is the same time. This is 1 hour time frame. This tiny candle you see here, it's 1 hour. This large candle here is also 1 hour. But you see, they are not the same. Meaning here we had like retailers doing things that they're doing here. But now when the big boys enter with billions, all right, now this is what you see. This is money. When money speaks, you see it. It's clear. You see how everything goes differently. These guys run the market. They run the system. You feel me? So now that we have these guys stepping in, we want to capitalize on that. We have a push, a very impulsive push. Now we look for the third confluence, which is fair value gap. Can we identify any fair value gap here? This is candle A, our first candle. Candle B is the second candle. Candle C is the third candle on this price leg that broke structure. So now we have a fair value gap because the low of candle A didn't close up with the high of candle C. So right now we're going to highlight that as our fair value gap. You can just like highlight that just like that. That's a fair value gap. Or better still, let's use this tool. Let's just put it like that. All right. It's just to make it not, like, so you know why I did it. I don't want to put boxes there and let you feel confused or anything. So that's the gap. This space here in between these lines is the gap that I'm talking about. Then now this is our key level or point of interest, whatever you call it. All right. This is where I'm looking to do what? I'm looking to enter this market and push it down. So this area here, you can call it your supply. You can call it your order block. You can call it whatever you want. I don't care. At the end of the day, we want to make money out of this market. So whatever you call it, whatever name you give it, does not matter. Make money. All right. So this is our supply zone. Why? We're looking to sell here. It's not like it's guaranteed because, oh, we've made our confluences where it's going to hold. Now, it is a probability. It's a game of probability. But now the odds need to be on your side. Why do I say so? The odds need to be on your side. First of all, this market is bearish. This market is bearish. And what are we doing? We are selling. We are going with the trend. All right. So now that the market is bearish, one, we are going with the trend. Two. So the odds are on our side because why? The market is bearish and we are selling. We are going with the bearish momentum of the market. Thirdly, we have a strong push. Secondly, and fourthly, we have what? We have a fair value gap. All of these things add up to what? Confluences. It adds up to the odds on our side. Good. Now that we have all of this, we say, okay, good. Now, whenever the price comes back into our zone, all right, whenever price comes back into our zone, we're just looking to take what? A trade to the downside. So I told you for the purpose of this video, let's keep it extremely basic. So you can I have a way of entering this market with these large zones. I can just use this my tool. I have a tool here that I've crafted. I can just measure that. Then I take maybe this point here. I don't usually like the midpoint is good, but sometimes it doesn't get tapped. So you can use a midpoint, and you can also use the entry, the opening of this area here. But like I told you, I made this tool for my entries specifically. I use it only for my entries, and they give me crazy entries. So I do that and I aim for 1 to 3 on most of my trades, one to three. When I'm using this strategy, I go for 1 to 3. When I'm using my other strategies, I go for 1 to 2. So this strategy is good because it gives you a high win rate. But you also have to be aware that if you've not mastered this particular strategy, you end up with more losers than winners. But at the end of the day, you still be positive, you still be on the winning side because you have a high risk to reward. You feel me? Like if you place 2 trades, you're up 6R. But if you lose like let's say you've passed just 2 trades, right? But if you lose 3 trades, you still be up 3R, even though you've lost more than you've won, but you are still winning because you have a huge profit. Okay, now that that is out of the way, we have our trade desk set. Now let's clear this out and let me show you another example. Now look at this. I want you to look at this very well. You can see that price is pushing here. We have a high. We have a high here, and we'll have a low, right? And we'll have a low here. Good. We have a high, we have a low here. Oh God, this is all right. Then we have another high here, which is relatively equal to this one, and we have another low. So this is a ranging market. So what we want to see here is a break. All right. So now that we have a break of this side, what do we call this? This is referred to as change of character. So change of character, my friends, is when we have if the market was bearish, if the previous structure was bearish like this, all right, then the recent low, which is this one, and the recent high gets taken out. This recent high here gets swept. Boom. That's a change of character, meaning the market is changing character to the upside. So now we are looking for buys because why? Instead of lows getting broken, because on a downtrend, lows gets taken out, not highs. So when the high gets taken out, we say, okay, things are switching up. So now we start looking for what? Buys. Beautiful. Now we had a change of character here. You can see immediately after this change of character, the market pushed up. That's just how it works, okay? The market cannot push up without a change of character. You will see it. This is the market telling you that, oh, I'm about to start doing things different. Feel me? So now look at this price leg that broke structure. It's really impulsive. It's impulsive. It's impulsive. It's even impulsive. Look at this. This is noise. Look at these wicks and all of these things. It's indecisional, meaning there's almost equal sellers and buyers. The momentum is not really clear. But here you can see that buyers were very dominant. You can see it there. You know that, okay, now these guys cannot be competitive with anybody. So these were the big boys. So you need to identify them. This is their footprint. This is their footsteps. This is what I meant by their footsteps. So now they've left us footprints, and now we're coming to follow that real quick. So now we have a strong push. So now how do I highlight my key levels? I usually come on the last bearish candle, which is this black candle here. I take the highs and the lows, and that's perfect for me. I'll put it out like that. So this, my friend, is a demand zone. This is the area where I'm sitting on my money and I'm waiting for the price to come back to. So the laws of this whole thing, or the whole idea of trading, is to buy low and sell high. All right. So if I use my Fibonacci to draw from the low here to this high, guys, anything above this golden zone here is premium. Anything below it is discount. So in business, you want to buy low, you want to buy as low as possible so you can sell high in order to make profit. That's the purpose of business, profit making. So we have a discount area here, which is perfect for buying. We also have a change of character. We also have a fair value gap. We have a imbalance. We have the space that I was talking about earlier. This is it, clear. All right, this space here, I will not go too in depth with it. You can watch videos on it. I also have videos on this channel talking about this fair value gap stuff. So you can check out my channel. All right. Or you must not watch my videos. You can go on other videos and watch. All right, please. I'm just saying. Good. Now we have a demand zone. We're hoping that when price comes back here, we buy. So I'll use my tool, like I told you guys. This is my special tool that I use on my entries. Beautiful. You can see I'll draw it there and I'll enter here. This line here is my entries for buys, and this one here is for my entries for sales. Beautiful. So now I'll just place my buy limit. You see that entry is a perfect entry. If I was on this trade, I'll have the best entry in the world. And then stop loss is just put it below the zone, and I aim for 1 to 3. Like I said, this using this strategy, guys, please, using this strategy, 1 to 3 is perfect. It's really good. So these are the two examples for buys and sells that I'll give you guys. So I've given you a break of structure and I've given you change of character so you can understand the whole thing. So you should know when to buy and when to sell. The odds should be on your side. You should count all of these things, put them to confluence, because I mean, bro, so if you enjoy this content in any way, I'm not a big YouTuber, so I must not be a big YouTuber before you support me. All right, I'm small, but still I'm giving you value. I'm giving you value and I'm providing you with great content here. I'm not here to flash out lifestyle or everything, but I'm here to share my ideas with you so it can help you on your journey to becoming a good and profitable trader. So once again, my name is Gislen and you're watching Forex Hybrid. Links are down below. If you want to join my free Telegram, it's there. If you want maybe advice, private coaching or anything like that, just click the links down below. I'll see you in the next video.